Well, today we think they will raise the inflation projections. They will announce the end of APP, and we think they will effectively pre-announce the first hike in July, given the high inflation pressures. Now, our base case is that the Governing Council then hikes 25 basis points in July, and at each of the subsequent 7 meetings, to get to 1.5% in June of next year. But of course, there is uncertainty around this in both directions, given the very uncertain economic outlook. So we think there is a scenario where they need to pick up the pace to 50 basis points if you get stronger second round effects than we currently anticipate. But of course, there's also a chance that having started, the ECB needs to pause at some point if you get a ban on Russian gas, for example, or if you get sovereign stresses in the periphery.
Let's pick up on that sovereign stresses, Jari, because as you know, there's been a lot of speculation that we might get slipped into today's announcement, plans for a new support mechanism for sovereign paper, specifically Italian, Spanish and others in Southern Europe. How worried are you about the spread that's widening between the Bund and the Italian paper?
So I think the rising interest rates in Southern Europe do, of course, need to be monitored in the context of high debt levels and also slowing growth, at least slowing real growth. For now, nominal growth remains very strong because we have high inflation, and of course, tax revenues, for example, in Italy have been very strong. But we do think this is a situation the Governing Council is looking at very clearly. They have committed to avoid fragmentation risks. So in other words, pledge to step in if you did see a non-fundamental widening in spreads, but we don't look for a lot of detail around what such a backstop could look like today. We think they have an incentive to signal strong commitment to avoid fragmentation risk, but to keep the details fuzzy here. And we think ultimately they're going to be more reactive with this backstop.
Jari, can I ask you about the market pricing? Because BlackRock says that the market is anticipating too many rate hikes from the ECB, with a call out there for 2% on the deposit rate by the end of next year, saying that's just simply too high. What do you think? Is the market getting ahead of itself?
Well, there is quite a lot priced, of course. For the next few meetings, you are sort of basically in between a 25 and a 50 basis point hike. Now, as I said, our own base case is that they go 25. Larger increments are possible, but don't look like the base case at the moment. In terms of the terminal rate, we are at 1.5%. To us, that will take policy slightly into restrictive territory. We think the neutral rate is about 1.25, but we don't think that level will be reached until the middle of next year.
It's good 50 basis points below the terminal rate that the market's seeing. Let me then ask you about the role of the euro at this stage, because we are still trading down on euro dollar for this year. It's been a dollar is king story. But obviously, if there's an improvement in euro and some of that potentially based around expectations of the ECB, how does that help tackle the inflation story?
Yes, the euro, of course, matters significantly for the inflation outlook. I mean, the rule of thumb here is if you get a 10% move in the trade weighted in the broad euro, that tends to affect inflation by about 1% over 2 years. So a significant effect here. Now, the euro, of course, has been weak because the growth outlook in Europe has deteriorated and the Fed has pressed ahead much more quickly than the ECB. But we do think the euro is going to strengthen over the next 6 to 12 months as the ECB takes rates first to zero and then above zero. And so that should help to cool some of these inflation pressures, particularly because commodity prices, of course, do tend to be denominated in dollars.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.